Hello everybody, this is Chuck Carnevale. Welcome back to part 2 of my current income dividend stocks. In this part I'll be covering 8 more. And I decided to break this into 2 videos just so you could, have a little breather, maybe go get yourself a cup of coffee. But really, when I'm covering this many stocks, these videos tend to get pretty long. And keep in mind that I'm only showing you a cursory view of each of these companies here, just essentially by the numbers according to FastGraph. So let's go ahead and review real quickly what we did in part 1. And by the way, if you liked part 1, I hope you liked it. I hope you subscribe to the channel if you haven't already, and I hope you share it with your friends. And I'll ask you to do the same with this video. If you think it's worthwhile, then please go ahead and do all the nice things. Give me a like and ring the bell and do all those things that help me grow this YouTube channel so I can help more people. But anyway, let's go ahead and get looking at this next second group of stocks here that we're going to be talking about. I ended with Unum and Prudential, the financials in the last. I'm going to cover 4 energy stocks, and these are all oil and gas storage and transmission companies, master limited partnerships. I believe they all have a K1. I'm not certain of that, so you might want to check with each one, but that's something that sometimes causes problems, but we'll talk about that later. Then I'm going to cover some tobacco stocks, consumer staples, British American, Philip Morris International, and Altria. And Altria is kind of a bonus because I actually covered it in the last video, but I'll mention why I'm also repeating it in this video. And then finally, I've had several subscribers ask for a comparison of AT&T and Verizon. So this will be we'll end with a preview on Verizon and AT&T and what they look like as good income investments. But remember, this video and the last video I did is all about current income. When I look at dividend yields here, the lowest dividend yield that I've covered in part 1 and part 2 is 4.1%, and that was Unum. And then the highest I covered, which we haven't covered yet, we'll be covering in this video, will be Magellan. But notice that Enterprise Products and British American Tobacco and a couple of the healthcare REITs that we talked about, this is where you're going to get the highest yields in today's market. So let's go ahead and get started, and let's move into the oil and gas storage and transportation companies first. Now, I've got Enterprise Product Partners up here. It's BBB+. That's a very high rating for these oil and gas transportation companies. It has 52% debt. And I do want you to notice a couple of things here as I go through all 4 of these stocks. Number one is earnings tend to be a little erratic. Okay, the white line on this graph is dividends. So when I'm looking at the historical performance, I do want you to notice there will be numerous times where the payout ratio of earnings is significantly above. In other words, in some cases, almost 300%. Here you have 100%. In other words, they're paying out all of their profits. That's because these stocks are all about the income, okay? And therefore, when I'm looking at these companies, I really prefer to look at them from a standpoint of operating cash flow, okay? Because I believe this gives you the best look at these stocks. But I'm also doing double duty when I'm looking at operating cash flow. In addition to whether or not I think these stocks are good investments, you'll see there's been a very good correlation here. This was a period where their operating cash flow dramatically exploded, and that had to do with taxes and other things, which I'll let you figure that out for yourself. But I want you to notice the company, in this case, Enterprise, follows its cash flows pretty clearly. But what I'm really looking for here is I'm really looking to see if the cash flows are covering the dividend, okay? In other words, are the cash flows higher than the white line, or is the orange line above the white line in this example? Okay, and that's what I'm really focused on here. Does the company have adequate cash flows, to pay this dividend? Now, there was a time when the operating cash flow payout ratio did get rather high. And again, if I look at that from a standpoint of the performance table, we can see that there were 2 years where they paid out virtually 100% of their cash flow, but otherwise they're paying out 65 or 70% of their operating cash flow. Now, if you look at this from the perspective of valuation, you can see, even if I bring back the normal multiple of cash flow, you can see it's trading at a discount to how the market's normal 11 times cash flow that it's applied over this long-term chart. That gives me a blended operating cash flow yield of 12% and a dividend yield of 7.8%. But again, these stocks are all about the dividend. So when I look at the comparison to an index, for example, if you put $10,000 in this in 2000, you'd have received 3 times, $30,433, more than 3 times your original $10,000 investment that you put in. Your $10,000 would be worth $29,000, so you almost tripled it. You can call this a double triple, if you will. And it would have almost equaled the S&P 500, just came in slightly below that. But when you combine dividends plus growth, you can see it dramatically outperformed the S&P 500. But before I go on, I want to show you something else. I don't know how scientific, how intellectual this really is, but as I looked at these oil and gas transportation companies, I did notice, if you look here at the white line, which is the dividend line, a really great value indicator is the dividends. So if I take the operating cash flow off of the graph and look at the price in relationship to the dividend income, notice how clearly you have a valuation indicator. You want to buy this stock when its price is, in line with that dividend. If you're a Fast Graph subscriber, you want to avoid it when the price, is significantly above the dividend yield line. And then, of course, now we've had this very attractive valuation, and you can see that it's also moving back into alignment with that. So that's just something interesting about these oil and gas storage and transportation companies. So this is Enterprise Product Partners. I believe it's one of the highest quality of the group. The next I want to look at is Magellan, another very high quality one, BBB plus rated. Again, you can see a nice relationship between earnings and cash flows. They're currently yielding 9.38% if you buy it today. And again, I think that's more a function of valuation than it is, anything else. The dividend is expected to be frozen for the next couple of years. That would be a negative, assuming it happens. That might not happen, because when I look at the company historically, they do have a good long-term record of raising their dividend. However, last year, they only raised it by less than 2%, but the long-term average has been over 14%. So this company at least has a history of going ahead and giving you dividends, and the payout ratio, again, is very high, which is typical. If I play that same game and take cash flows off of the graph, once again, you see this very interesting correlation between the dividend and the price. And, when you can buy the stock when the price is below the dividend line, if you will, it's a good time to buy it. When it's above it, that turns out to be a less than great time to buy it. But it doesn't mean you can't make money, as you can see here. And right now, it's trading significantly below that. So there's Magellan Midstream Partners, 9.8% yield, BBB plus rated, operating cash flow yield of over 11%. The next one is TC Energy. And here, we see a pretty good relationship between earnings and price. If I go ahead and play the game as I've done with the other two, if I put operating cash flow here, remember my focus is I'm looking for operating cash flows covering the dividend. In the case of TC Energy, which is a Canadian oil and gas storage and transportation, you can see that the cash flows have more than covered the dividend. When I look at the payout ratio of cash flows, it's been in the 30-ish, as high as 40% occasionally, mid-30s occasionally. But, it's essentially got a very low payout ratio relative to its cash flows. I consider that a plus. When I look at the normal valuation of this stock based on its operating cash flows, it trades at around 8 times operating cash flows. That's almost exactly where it is today. So it's not necessarily a great bargain, but it's certainly attractively valued, offers a 5.74% dividend yield and an operating cash flow yield of 12%, which in my view is extremely good. Operating cash flow multiple is 8.3, which is basically in line with its historical norm. It's, again, BBB plus rated, 53% debt to capital. The next company I want to look at, now I'm going to move away from the energy stocks and move into the tobaccos, or the consumer staples, if you will. And British American Tobacco is another example of a very inexpensive consumer staple. The company's BBB plus rated, has 47% debt. You can see how the price correlated to earnings for all these years. The dividend record on this one's a little bit spotty, but not bad. It's had, really tremendous growth. They did cut their dividend in 2018, and they cut it in 2014 and 2015, but only marginally. Otherwise, they've thrown off an enormous amount of dividend income relative to the market, again, going back to 2000. And you can see that their stock price has tracked earnings, and it's now become very inexpensive for the last several years. And I believe the risk is in the valuation. In other words, the risk is already priced in on this stock, is the way people like to say that. It's got an earnings yield of 11.65%, dividend yield of 7.53%, BBB plus rated with 47% debt to capital. For all the tobacco stocks, it might be a favorite in that regard. It's got a great, long-term dividend record. Now, this is an ADR. So therefore there is some exchange rate issues that might have affected the dividends here. If you looked at the company on the London Stock Exchange, you might see a slightly different picture, but this is adjusted. This is in US dollars, and this gives you a good picture of what this company looks like. It's been a really good, long-term investment. If I move on, I did cover Altria, and I brought this up because I wanted to have a little fun here. I did have a subscriber that kind of didn't like the idea that I said in the video that I did last week when I covered this, that I can't get over calling it Philip Morris. Well, part of the reason for that is the symbol has never changed. The symbol for what was originally Philip Morris, the company's original name was MO, which is an abbreviation for Morris. And, it was trading at that. The symbol's still MO. So, I'm an old soldier, been doing this for 50 years and have followed this company literally the entire duration of my career in the industry. And it's always been Philip Morris to me. So it is now Altria Group. That's true, but the symbol's still MO. But you can see we've got a 6.5% dividend yield, earnings yield of 8.4%. This is, again, another one that's very attractive based on valuation. If you look at it from a standpoint of analyst estimates going forward, there's significant. Here's a case where you got high yield and high potential capital appreciation, assuming the stock goes back to its normal valuations. The opportunity for the next couple of years, even if we, slightly discount that a little bit, looking at the normal PE ratio of 14 only, you still would average over 18% a year going forward, and you're paid 6.5% while you're waiting. But one of the spin-offs to this company, the original Philip Morris, if you will, now known as Altria, was Philip Morris International. Now, this one is also attractive, offers a 5.3% dividend yield. It's A-rated, does have a lot of debt, but the company generates enough cash to amortize that debt. Let's take a look real quick at operating cash flow here for Philip Morris International, because again, for these dividend-paying stocks, that's very important. And as you can see, cash flow covers the dividend nicely, but the dividend payout ratio of cash flow is very, very high. But what makes these tobacco stocks interesting has been the dividend yields. They've attracted investors based on the yield that they put out. You get over a 5% yield. Company's A-rated, but it does carry a lot of debt. But I do want to make just a quick comment about debt. Debt today is way different than it was, years ago. When you look at, long-term treasury bond rates here, when the rates got, currently at about 1.57 as of February, but, by the end of last year, it was down to 0.5%. That was the 10-year Treasury note, yield. So in these very low interest rates like we have here, companies are able to take on debt. They don't have to pay very much to borrow money, and they can invest the money at much higher returns on investment, and therefore, they do that all day. When you can borrow money this cheaply, companies are taking advantage of that because it's cheaper than issuing stock. And the other side is, and you don't want to issue stock when your valuations are low like this, by the way. If you were going to issue stock, you'd want to issue it when you could get the valuations real high. But the point I'm getting at is these companies can borrow money very inexpensively right now, and they can borrow money for 3 or 4 or 5% and earn 9, 10, 12% on that money, and they'll do that all day. So the final two stocks I'm going to cover in this video are the two that were actually a subscriber request. And I've talked about AT&T in a separate video, so I'm going to kind of repeat what I talked about. This company was originally purchased by Southwestern Bell, I think about 10 or 12 years ago. And so if I look at this stock, I really don't like to look at AT&T going back a long ways. I like to look at it, since about 2010, because this is the current AT&T. Now, the stock is very inexpensive. It's competing obviously in the cellular, but it's also got the streaming products and so on. This is one that's worth spending some time looking at. Forecasts for future growth are expected to be relatively low. I admit that, but you can get this stock with almost a 7% yield. I would consider this a bond-like alternative. There is capital appreciation potential built in here, assuming that, this stock moves back even to a 12 or 13 PE, you could make, 17%. So the risk is already built in. It has 51% long-term debt to capital, which I believe is fine. This company has the cash flows to cover that. So AT&T is really all about the yield today. It's a yield investment. And then if I look at Verizon, which is, also a close competitor of AT&T in the integrated telecommunication services. These companies are in the same sub-industry. Here's AT&T, here's Verizon integrated, but they do different types of business, but their businesses are very similar. When I look at Verizon, I can get a 4.31% dividend yield, so the yield advantage goes to AT&T right now. I think that's important. However, the stability here might be something about Verizon. Verizon's only grown the dividend by about 3%. I do want to point that out. If I go back to AT&T and look at their dividend growth, it's averaged about 2%. So neither one of these stocks are growing their income at very high rates, but they are paying a very high dividend yield. Currently, the dividend yield is over 4%, and it's extremely attractive. This is more of a bond-like type investment, BBB rated, 64% debt to capital. You can buy it below a 12 PE. I think that's extremely attractive. I look at the long-term history of this stock. A 15 or higher multiple has been very common. Notice that the normal PE and the blended PE is about 14, 13.99. So, I do think the stock is inexpensive at a blended P of 11.7. Anyway, that's Verizon and AT&T. You asked for it, and so now you got it. This will be a preview of tomorrow's subscriber request. Remember, for those of you who asked, you already got Verizon and AT&T. Anyway, this is it for today. This is part 2 of my investing for current income. Don't forget, you can mix and match these with lower yielding, faster growing stocks to ratchet up your overall yield, and use your imagination and creativity, because it is a market of stocks, not a stock market. And stocks come in all different flavors, sizes, categories, growth rates, yields, growth yields, all those things are different, and you can use your imagination and your judgment to build a portfolio that meets your own unique goals, objectives, and risk tolerances. Thanks for watching. If you liked what you saw here, don't forget to give me a like, hit the thumbs ups, hit and subscribe if you haven't already subscribed, and also tell your friends. I really appreciate all of you, and I look forward to tomorrow's subscriber request video series. Talk to you tomorrow.